What's going on, PFR Nation? This is Kevin Lau, your host of the Planning for Retirement podcast. And today we're going to be talking about qualified charitable distributions, or better known as QCDs. And more specifically, we're going to be talking about a common mistake that we see year after year. And so if you are planning to donate to charity at some point in time in the future, QCDs could be a great strategy for you. And you want to make sure you get proper credit for this. So we're going to talk about what a QCD is, we're going to talk about who it's for, and we're going to be talking about how it impacts your tax return and ultimately your taxable income, and why you want to make sure you have proper communication and documentation with your tax preparer. So without further ado, why don't we jump into the whiteboard. So QCD, what is a QCD? It is a qualified charitable distribution. And so the IRS allows for individuals, IRA owners more specifically, that are over the age of 70 and a half. So you have to turn 70 and a half in the year you make a QCD. Why 70 and a half? Well, several years ago, prior to the Secure Act, it used to be the RMD age, the required minimum distribution age. So it kind of synced up really well. But the Secure Act 1 passed in 2019, and then it pushed back the RMD age to 72. And then Secure Act 2.0 pushed it back to 73 and 75 for some individuals as well. It depends on your year of birth. But nonetheless, if you're over the age of 70 and a half, you can donate to charity directly from your IRA. Okay, and that is a very key point. Okay, so it must come from a traditional IRA. Okay, it cannot come from a 401k. Nope. Cannot come from a 403b plan. It cannot come from a TSP account. And then more importantly, more specifically, I hear this question all the time from clients is, it cannot come from an inherited IRA. Okay, so it must come from your own IRA. Okay, so if you are an IRA owner and you're over the age of 70 and a half in the calendar year, you could donate currently in 2024, by the way. If you're watching this in the future, in 2025, it'll be a different limit. But for 2024, the amount you can donate is up to $105,000. Okay, for 2025, there was an inflation adjustment, and they allow for an additional $3,000. So in 2025, you can donate up to $108,000. Okay. Now, how common is that? Not very common. I've been practicing for a while. I typically serve, folks that have, somewhere in the $1 million to $5 million investment account balance range. And so, most of my clients are, their RMDs, the required minimum distributions, might be in the range of $60,000 or $70,000. Okay. And so, while they may not donate $105,000 or $108,000 per year, sometimes they are donating multiple five figures. Okay, maybe it's $10,000, maybe it's $20,000 directly to a charity, and that is the key here. You cannot take the money out of the IRA and then write the check to the organization. Okay, the check, the donation, has to go directly into a qualified 501c3 organization. So a real charity. Generally speaking, this has to be a U.S. charity. Okay, I've had this question before as well. I've had some clients that have family overseas, and they were wondering, hey, can I support a charity that they are involved with in India or in somewhere in Europe? And generally speaking, my belief is the answer is no. Unless the charity is domiciled in the U.S. and they operate overseas, the answer is probably going to be no to that one, because this is a tax benefit for U.S. taxpayers. We want to benefit. We want this to benefit U.S. 501c3 organizations. So it must be a qualified charity. But here's the thing. That is really up to you, the taxpayer, to determine what a qualified 501c3 is. Okay, I hear this all the time is, what about, can I donate to, this GoFundMe page, for this individual that got hurt and they need support. That's great, but that is not a qualified charity. All right, so but it is up to you to verify this. All right, because technically speaking, when you do the qualified charitable distribution, you're essentially going to go to the custodian of your IRA and you're going to fill out a form that says I want to donate directly to charity. So that avoids the money going into your hands. It goes directly in to this qualified 501c3 organization. And if it does that, the organization, of course, they're not going to pay taxes. They don't pay taxes on any donations if they're a qualified charity. But the key is you also don't pay taxes on that IRA distribution. Normally, if you take a distribution out of a traditional IRA, you are going to be taxed as ordinary income. Okay. And so that is the key here for the qualified charitable distribution, is that you're donating directly to a charity, and that income is never recognized on your taxable income, on your tax return. Okay. And so it essentially operates more efficiently than a tax deduction. A tax deduction, you donate to charity, you add up all of your itemized deductions at the end of the year, and if your itemized deductions exceed the standard deduction, then you will claim itemized deductions and the charitable donations will count. But that is a tax deduction, okay? That's reducing your taxable income. This is never even included in your income. So regardless if you're itemizing your tax deductions or taking the standard deduction, you could just donate these dollars directly to the charity, and that income that otherwise would have been counted as income is not going to be counted as income. So super powerful for those who are over the age of 70 and a half that are charitably inclined. But it's even more powerful. Okay, this is really where it unlocks even more power, is if you are taking required minimum distributions. Like I mentioned, for most people, it's going to be either RMD age now is going to be either 73 or 75. I believe the year of birth is 1960. If you were born 1960 or later, your RMD age is going to be 75. If it was prior to 1960 and you have yet to take RMDs, it's going to be age 73. Okay, so that's important, because when you retire, you might have a gap between when you start Social Security and when you start taking required minimum distributions, where you can really get aggressive and try to tackle this RMD trap that a lot of people run into. This is a lot of folks that we've been working with for the last decade or so, prior to Roth conversions really becoming a mainstream recommendation for clients, is that they have this RMD trap. They're taking required minimum distributions. They don't necessarily need all the income. Maybe they're taking out $60,000, $70,000 per year, and maybe they only need $20,000 of it. Okay, so they're taking the delta and just reinvesting into a brokerage account. Okay, which is fine. That's not a bad thing. It's a great strategy. Taxable brokerage account, one of my favorite strategies, one of my favorite buckets to use, not just for retirement planning, but more specifically for estate planning, because of the step up in cost basis at your death. Okay, but this is really where that QCD could come into play, all right? Because if you have, let's say, an RMD, let's say it is $50,000, okay? And normally you're donating to charity, and you're over the age of 70 and a half, so you're eligible for the QCD. So you're saying, hey, you know what? I normally give $10,000 to charity, and but I'm not itemizing my deductions. The standard deduction from the Tax Cuts and Jobs Act doubled, and so therefore I don't need all of my income, my RMD, okay, and I'm not deducting my charitable donation. So what do I do here? This is where that QCD could come into play. Okay, so what you could do with that RMD is you could say, you know what? Let me donate $10,000 via the Qualified Charitable Distribution. I'm going to pick a recent one that our client donated to, which is St. Jude. Okay, St. Jude Research. And so now St. Jude has the money, so $10,000. You normally gave $10,000 to them anyways, but typically you were giving cash, which, by the way, is probably the least efficient way to give. If you're going to give out, let's say you're not 70 and a half yet and you want to donate to charity and you've got some financial assets, it may benefit you from looking into other vehicles. Maybe it's a donor advised fund. Maybe it's gifting appreciated securities like stock, bonds, ETFs, mutual funds, etc. Okay. But anyways, but for the QCD, let's say, now you have this $10,000 and you say, you know what? Normally I was taking $50,000 as an RMD, and all of that's included in your taxable income. But now you want to take this QCD and say, you know what? All right, I fill out this form. Oh, that's all you have to do. You go to your custodian. We custody with Charles Schwab. So you go to Schwab and you say, hey, give me the QCD form. I'm going to sign the QCD form. I'm going to write St. Jude, the amount of $10,000. You're going to write your account number, where it's coming from, and you're going to write the address. Maybe there's a special attention. Maybe there's a specific fund that you want to donate to within an organization. You can put all of that information in the form, and you can donate to multiple charities. It doesn't have to just be one charity. So I think the QCD form with Schwab, I think they have up to 5 that you can name on one form. So if you want to donate, if you donate to 10, you have 2 forms. Okay, that's really all it is. It's just paperwork. But in this example, $10,000 goes directly to St. Jude. So now you back that out of the remaining RMD. So now your RMD, this counts as a distribution. This QCD counts as a distribution. So now your RMD remaining equals $40,000. So you basically just reduced your taxable income by $10,000 without having to worry about itemized versus standard deduction. And because of the Tax Cuts and Jobs Act, only 10% or fewer taxpayers are actually itemizing deductions these days. So chances are you are taking the standard deduction. So now you've reduced your taxable income by $10,000, but you're not done yet, okay? This is really where the mistake happens, okay? And oftentimes it's just because of lack of communication, lack of a proactiveness by the client, maybe the financial advisor and the CPAs, just really being inundated with tax returns during tax prep season. This is why we create the tax letters for clients at the beginning of the year. We give them a list of all their 1099s that they should expect, all the tax forms that they should expect, at least that we know of. Okay, sometimes clients have other assets that they don't really share with us or they forgot about and they get a 1099 and we didn't know about it. So we give them a list of things that we know about and we give that tax letter to them. And part of that is also including any charitable donations that were given via this QCD strategy, okay? So I pulled up 2 tax returns for clients from 2023, and we've got, scenario 1 here, and then we've got scenario 2. So if you can look at scenario 1, if you look at line 4A of this tax return, it says IRA distributions. And in this first box, it'll have the total distribution amount. In this case was $50,359. Okay, this client did a QCD last year. We gave him the tax letter. He gave that tax letter to the CPA. Okay, I'm not blaming anybody, but I'm just saying this is what that mistake is. So if you're doing QCDs, you just need to be a little bit more proactive with your tax preparer. Maybe just write that in an email in addition to whatever you send them and say, hey, by the way, part of my distribution is a charitable distribution, because when you get the 1099-R from Schwab, Fidelity, or whatever it might be, they're not going to segment that out. They're not going to say, hey, your distribution was 50,000, but you did a 10,000 QCD. That they're not going to do that because why? It's liability. They cannot verify if that is a qualified 501c3 organization. They don't want to be in the hook for that. At least that's my guess. There are some custodians now that are documenting this properly. So hopefully this fixes this whole mess. So maybe in 2025 or 2026, you're looking at this video and this is completely irrelevant at this point in time. Hopefully. But probably not. It's probably going to take a little while for the big custodians, Schwab, Fidelity, Vanguard, to catch up with this. So I couldn't remember the exact donation this client made, but they made a donation, a QCD donation. But you can see in in box 4B, this is the taxable amount was also $50,359. That's wrong. They did a QCD. It should not be $50,359. Let's look at this other example too down here. All right. So in this example, same scenario, looking at line 4A and looking at that first box, we've got the total IRA distribution. And this time is a little more, this is their requirement on distribution. This client's a little bit older. Their IRA balance is a little bit higher as well. So they're taking roughly $76,000 out of their IRA. And last year, this client did a $10,000 QCD, Qualified Charitable Distribution. Look what the tax preparer did. They put in a little QCD right there. And then in box 4B, they said taxable amount is $65,999. This is the amount that's going to be included in their taxable income. That's how you do it right there. And then furthermore, you just need to document it. So with your tax records, typically the charity will send you some sort of thank you letter to say thank you for your $10,000 donation. Just save that, or go into your custodians, log into your online your IRA access online. Sorry, I can't talk right now. Log in and go to that statement and it'll say IRA distribution, and you document that, sort of, parlay that with, the receipt that you get from the organization. And sometimes you might need to proactively ask for it. Maybe you're giving to a small local animal shelter, and their documentation is not like St. Jude might be. Okay. St. Jude probably will send them a letter with the specific amount they donated, but maybe you gave to your church, or maybe you gave to a small, a local food bank. They may not have it buttoned up, so you may need to proactively ask for this, but just get that documentation, put it in your tax file, save it, and now you can see This is documented correctly. So it's really all about proactive communication with your tax preparer, making sure they know that not all of your IRA distribution was taxable and that you did a qualified charitable distribution. They're not going to ask for any receipt. They're going to just document it like this. They're going to put in this QCD. This is typically what this is what I like to see from tax preparers. I've seen some tax preparers not put that in there, and they just put the the taxable amount here in box 4B, whatever. But just make sure you document it, and just make sure that this box 4B reflects the after donation amount of that IRA distribution. So hopefully this helps. And if you are planning on doing a QCD, you still have time before the end of the year. Before December 31st, you can make a QCD. For our practice, we've really had those conversations with our clients over the last couple of months. We know who's going to be making a QCD, and just about all of those are finished at this point in time. But it is the holiday season. Maybe you're sort of thinking through, hey, you know what, I want to donate, and maybe you've already satisfied your minimum distribution. You don't even need to worry about that. I mean, let's say your minimum distribution was 50 and you already took 50 out of your IRA, and you're like, oh man, I wish I would have donated to charity before that. That's okay. You can still do the QCD. It's not going to be a taxable distribution. That's money that you otherwise didn't need to pull out of the IRA, but it can almost act like a Roth conversion. If you're trying to tackle this RMD trap that a lot of people run into down the road and sort of minimize their IRMA surcharges, etc., maybe you sort of look at that as a Roth conversion. You're taking out more than you really need to, but ultimately you're looking to give to charity. You want to benefit that organization. So QCD is not for someone that's just looking to minimize taxes. You need to be charitably inclined, because this is money that you otherwise didn't need to pull out of your account that you're pulling out of your account. Okay, and that doesn't make sense. So I've seen that before, where clients are just looking to minimize taxes. Well, you're still minimizing the dollars that should have been in your pocket by donating to charity. So if you didn't want to donate to charity, don't do it. Okay, do your due diligence. Make sure it's a charity that aligns with your value system and who you're looking to impact. And if it does, this is a great strategy, again, if you're over the age of 70 and a half. So I hope you have found it helpful. If you're in that PFR Nation sweet spot, if you're sort of in that 50 to 60 plus range, you've exceeded 7 figures of investable assets. Maybe you're approaching mid 7 figures, maybe even upwards of 8 figures. You're looking to achieve work optional. You're looking to minimize taxes in retirement. Maybe the bulk of your assets are in tax deferred vehicles like IRAs, 401ks, 403bs, and you want to optimize your retirement income plan in the most tax efficient way possible. Make sure to follow this channel because that's what we do. That's what we talk about. And again, make sure to check out the podcast that we just put out. I think it was last Thursday, Thanksgiving Day, tax planning opportunities prior to year end. So check that one out, and hope you all found it helpful. And we'll see you next time.